As a mutual fund distributor, we are always dealing with uncertainty. We are responsible for giving confidence to the investors about the future of the markets, how it is going to perform, what could be the expectations, and we have to keep them motivated to stay invested because everybody loses motivation when the markets come down. In the past 2 years, we have seen a lot of volatility in the market, and because of that volatility, we are trying to figure out the reason for it. Is it the FIIs? Is it the earnings of the company, or is it something else? Any guesses? What is the reason that the markets have been volatile for the past 2 years? Can I get some guesses from all of you? The reasons for market volatility? No, war was just recent. I think so many people guessed it right. It was Twitter and Trump. Yeah, that also is there, but that was for the past 3-4 months we have been seeing it. But altogether, in the past 2 years, we also do not have a response. To be very clear, we cannot give any clear response to the people. So the Indian markets have been on a ventilator. Will it continue to be like this? So let's listen to Mr. Neelotpal Sahai, what he has to say on this. Yeah. He is a seasoned investment professional with extensive experience across Indian equities, portfolio management, and global investment advisory. As Director of Indian Equities and Head of Offshore Advisory at HSBC Mutual Fund, Mr. Neelotpal Sahai has been instrumental in guiding investment strategies for both domestic and international investors. With a deep understanding of India's evolving growth story and market dynamics, please join me in welcoming Mr. Neelotpal Sahai as he shares his insights on Rise Through Uncertainty and Volatility, the India Growth Playbook for FY27 and Beyond.
Hi, and to invite Mr. Neelotpal Sahai on stage, I welcome Mahesh, our secretary, to welcome him with a bouquet.
We are expecting some energy here, everybody. Everybody came from a nice coffee break.
Sure.
Good morning, all of you.
Good morning.
All of you excited?
Yes.
See, the topic was about the rise from volatility. So we see ups and downs obviously in the economy and the markets, but we see the similar kind of ups and downs elsewhere also. One of the very prominent thing that where we see in a span of a day, ups and down is in sports. And cricket is our favorite sport. So let's see actually what happens in the sports. If you take a typical one day or a T20 match, then what happens is the first power play is there. The ball is coming onto the bat, and the field is all closed in actually. Outfield is not there, and there are boundaries. And a player like Suryavanshi is there, so there are sixes as well. The runs are coming very easily. Then suddenly what happens is that a couple of wickets fall. The players also are spread out. That's the time for the consolidation. It's also pretty normal thing. What do teams do at that point of time? They focus on preserving the wicket, want to ensure that they keep on taking singles and doubles and move forward and be ready for the final assault in the last 10-15 overs. And if the wickets are in hand, and then a lot of runs are scored. Remember, the matches are never won or lost in the first power play, or even for that matter in the first few overs. Only somebody has completed the full 50 overs and then done well throughout. That's when actually the matches are won or lost. Indian economy, Indian markets are not different at all. When we look at the phases actually, then this is what we see. The first phase that we see here is that of the power play. Everything working fine, everything working in synchronization. What you have actually is that the period of 21 to 24, in that period, you had ample liquidity. The capex, the government capex was growing pretty fast. That was setting the foundation, the base for the growth to happen. Earnings growth was there, and so that was the kind of power play. It was also, you can say that all the factors came together and the symphony was reaching its crescendo. It was not the normal thing. It was the best of the all worlds, and what we also called in the terms of economy as the Goldilocks scenario. Then came the next phase. Some of the things actually began to normalize a bit, like we'll see in the terms of the growth numbers. Liquidity also tightened, and there were some disruptions, both external as well as internal. External in the sense that in the 25 there was a trade tariff, and in this current year there was a war also. That has also disrupted our economy. So this is that period when the wickets have been falling, but the good captain actually ensures that the singles and doubles are being taken and the scoreboard keeps on ticking, which is what has been happening actually. But once you have consolidated well, actually, and that's the time to be ready, to be prepared for the next leg of growth. And possibly we are at that point of time, and which is why I say that it's time to rise again, which is what the theme of this, the conference is. Now let's look at some of the numbers basically to make this point very clear. The first thing is again the GDP numbers. And since we are talking about the full decade and split the decade into 2 or 3 parts, this part is of the better period, except for the dip that you are seeing, that is the COVID period. But without that dip, and if you average out the 21 and 22 period, then also what you will see, the growth numbers are broadly in the line of 10 to 11%. This is the nominal GDP growth numbers, which is considered pretty strong number. At the bottom of the screen, you would be seeing the credit growth number. Actually, it is peaking at close to 18 to 19%, 20% also towards the end. That is also not normal. So what the mistake one actually made in the middle of 24 or September of 24 was that we began to think the best of the conditions for the economy as the new normal. So like every other cycle, this economy and the market also goes through a cycle, and the bit of consolidation is actually important for the final assault to happen. And so this is what happened. After that, your credit growth began to come down. It went almost all the way up to the high single digits, low double digits sort of thing. And the economic growth numbers also actually came down close to 9% or so. This is again the nominal GDP number. But where we are right now is that the credit growth is showing some signs of picking up in the last couple of quarters or so. And the important thing is that both credit growth and the nominal GDP growth numbers will also narrow. So going back to the cricket analogy, this is the time for taking singles and doubles, making sure that you are making the best of the pitch which is not favorable right now, but is still ensuring that the numbers are coming. Remember, these numbers, the economy numbers and the credit growth numbers will look much better as compared to almost every other economy in the world. So one has to just keep on ensuring that the singles and doubles keeps on coming. It may not be the fourth and the sixes that we had got used to in the first phase of things. One of the points which I mentioned was that the bedrock for the growth was the capex that the government was doing. And a very important parameter is capex to GDP ratio. Now this capex to GDP ratio, if you see on the left of the screen, is close to 1.5, 1.6% or so. Now this is what it has been for almost 10 years, 15 years before that. So there was a limit to or constraint to the government finances, and which is why the government capex to GDP was by and large around that range. But you will also be seeing that the capex to GDP actually shot up pretty fast in the next 4 or 5 years. From FY20 to FY24, it moved from 1.56% to something like 3.2, 3.3% also. That was the best period for the capex to happen, and we all know that capex translates into the earnings growth. In the subsequent slide, we'll see that this was also the period when the earnings growth were at its best after 2 decades, since the 2 decades back. Now, what we are seeing actually since then, what has happened is that the capex to GDP has stagnated at around 3.2% and 3.1% in the last couple of years, and hopefully it will begin to pick up from the next year because the government has budgeted for a higher number, and if it's able to spend that, then the capex to GDP will again begin to see an uptick. It's already at a high number, so maintaining that number and taking it higher is a big positive. At the bottom of the screen, you will see the private capex chart, and that is for a much longer period, for the 26-year period that we are having here. I was wanting to show here is that what we are seeing right now is somewhat a replica of what was there in 2001 to 4. That was also the period, it was the precursor to the mega capex boom which happened in the next 3-4 years, but it was beginning to be led by the private sector capex and government capex all coming together. Now what we are seeing actually from the last FY23 onwards, in the last 3 years or so, is that the private sector capex has again begun to pick up. I'll again give one more data point. The result which has been declared for the fourth quarter and for FY26, the private sector capex has grown by 12.6%. It's a very strong growth number, and the good point, even better point, is that this growth has come from the cash flow from own operations. So the cash flow from operations has also grown by 12.5%, and private sector capex is also growing at that pace, so which is the good thing. And now if one has to actually look at this data, what has happened in the past and what happened in subsequent 4 years, 2004 to 8, and if that is any signs to actually think about, then the next 3-4 years can be significantly better. There obviously some wickets have fallen. So one of the thing is the currency actually. So between again in the post-COVID scenario till FY24, the currency was in a narrow band. It was not depreciating, and in the 7-8 year period, we saw that the forex reserves almost doubled from 370 billion. At the peak, it reached to about 700 billion also. So again, the best days for the forex, as well as for the currency as well. But then what happened? Because of the factors and the balance of payment crisis, etc., and more recently the crude-related crisis, etc., the currency has given way. So there would be some wickets to fall. Not every ball can be hit for 4. It's that simple actually. So one has to actually appreciate the changing condition, and so did RBI. It allowed the currency to depreciate to ensure that the trading, the export continue to be competitive, and now it has taken very strong measures in the last policy 15 days back to ensure that a lot of money, a lot of dollars come in, and that should ensure the fact that the currency should stabilize from there. If the economist estimates are to go by, and if one expects more than $50 billion to come in this FENRB, then that could be liquidity galore once again, and obviously that would be a big positive for the currency as well. Moving on to the corporate earnings, because this is the bread and butter and among the most important thing from our market perspective. So the corporate earnings were very strong, which I mentioned in the period of the high capex regime, and it also reached, it is from the quarterly basis, but it has reached 28%. Average is 28% growth, which is very, very strong. Normally, over a long term, the corporate earnings growth should be in line with the nominal GDP or from the money supply growth perspective. But that was the period when the capex was actually growing at a much faster pace than the rest of the economy, and that's why the corporate profit also was growing at a much faster pace in this period. But then again, as I mentioned, the period of consolidation happens, and over the last about 18 to 24 months, what we have seen is that the corporate earning growth actually slowed down initially. But the good news is that now we are beginning to see a lot of recovery. So on the bottom chart that you would be seeing, upgrades to downgrade ratio, and this is the term used for if what profit that we estimate for the corporate, if that is going up or coming down. In this case, this used to be close to 1 in the good old days, but it came down to 0.3, 0.4 or so in the period of consolidation. But that's again is beginning to go up. And what we are seeing actually in the last couple of quarters is that the earnings growth is back. And for the NSE 500 companies, earnings growth in this quarter was also 15%, which is a healthy one because it has gone into the mid-single digit in the past. Finally, the last slide that I have got is on the valuations. We see that the valuation for Indian companies did correct meaningfully, and it is almost 25% correction which is there. So much so that now the large caps are almost 1 standard deviation below its long-term average. So now we are in a situation when the power play was over long back, that was not the normal thing. Then was the period of consolidation when the wickets fell a bit, but the teams ensured that singles and doubles were taken, wickets were intact, and which is why now we are beginning to see in none of the thing actually India deteriorated meaningfully. And now is the time, because the wickets are in hand, is to make the final assault, and that means to achieve a very high score. So we are in a very good position at this point of time to capitalize on what we have done over the last 5-7 years or so, including the period of the consolidation. With that, I will stop the formal presentation. I will leave some time for Q&A if.
Thank you, Mr. Neelotpal. Yeah. So there are no Q&A.
There are no Q&A.
Because we'll take
Okay.
it offline.
Yeah, sure.
Please come to the center. I request Mr. Saravanan, President of Vellore Association, to come and hand over a token of.
But okay, let me myself ask a question in that case. Are you people feeling positive or negative? Okay, thank you.
Positive about what?
The markets, the economy, in general, actually, we should be, see, equity people have to be optimists, right? We have to look ahead and you have to be positive, actually. Even if the wickets fall, you have to ensure that we consolidate, actually, not worry. And in that also, in scenario also, the good teams are the ones actually who do better in those, because every economy, every market, every situation has to go through those cycles. There is nothing which is actually only one way, and which is what has been the case for the markets also. The important thing is that when the dip happens, how less actually we go down and how quickly we stabilize. So given that we had a 4-5 years of the mega run, so only 18 to 24 months of the kind of period of consolidation actually is less. And if we are already beginning to recover, that I showed you on many parameters like credit growth, on the corporate earnings growth, on the private capex, government capex, etc. So I think the better days are ahead. And that is the message actually which I want to leave with, because the wickets are intact, and we lost, okay, 2-3 wickets, but wickets are intact, and then we can score big runs in the remaining overs.
Thank you, Mr. Please, sir, come.